You could be sitting on hundreds or even thousands of dollars in tax savings right now and have no idea the clock is already running out on your ability to claim them. Most investors spend hours researching which stocks to buy and almost no time thinking about how to keep more of what they earn. That gap is where a lot of real money quietly disappears every single year. Not to bad investments, not to market crashes, just to a tax bill that could have been smaller with a little bit of planning done at the right time. The frustrating part is that the strategy we are about to walk through is not complicated. It is not reserved for wealthy people with accountants on speed dial. It is something any investor with a brokerage account can do. But most people either do not know it exists, or they wait too long and miss the window entirely. By the time April arrives and they are staring at a capital gains number on their tax forms, the opportunity is already gone. The moves that could have helped had to happen months earlier. That is exactly why this matters right now, before the deadline closes, and before you find yourself in that same position. Tax loss harvesting is the practice of selling investments that have lost value in order to create a loss on paper that you can use to offset gains you made elsewhere. The IRS allows you to subtract your investment losses from your investment gains, which reduces the total amount you owe taxes on. If your losses exceed your gains, you can even use up to $3,000 of that excess to offset your ordinary income, and anything beyond that rolls forward to future tax years. Here is what that looks like in real numbers. Say you sold a stock earlier this year and made a $10,000 profit. Without doing anything else, that gain is taxable. Depending on how long you held the investment and your income bracket, you could owe anywhere from 15 to 23.8% on that gain in federal taxes alone. That is potentially over $2,000 going to the government. But if you also have another position sitting at a $5,000 loss, you can sell it, realize that loss, and now you are only being taxed on $5,000 of gain instead of $10,000. That one move just cut your tax bill roughly in half on that transaction. The key word in all of this is realized. An investment only creates a loss for tax purposes when you actually sell it. A position that is down 30% in your account is not helping you yet. It is what the IRS calls an unrealized loss, and it has no tax value until you close the position. That is the action step most people skip because selling a losing investment feels emotionally wrong. It feels like admitting defeat. But you are not abandoning the investment forever. You are strategically booking the loss while maintaining your overall market exposure. This is where the strategy gets slightly more nuanced, and where people make the most common mistake. After you sell a losing position to harvest the loss, you cannot simply buy the same investment right back. The IRS has a rule called the wash sale rule, and it says that if you buy a substantially identical security within 30 days before or after the sale, the loss gets disallowed. You do not get the tax benefit. The 30-day window goes in both directions, which catches a lot of people off guard. They sell the losing stock, immediately rebuy it because they still believe in it, and then discover at tax time that the loss was wiped out entirely. The solution is to replace the sold investment with something similar, but not identical. If you sell an S&P 500 index fund at a loss, you could replace it with a total market index fund or a fund tracking a different but correlated index. You stay invested in broadly the same part of the market, your portfolio continues to participate in any recovery, but the original position was sold and the loss was legitimately captured. After 31 days have passed, you can switch back to your original holding if you want to. The same logic applies to individual stocks. If you harvest a loss on one technology company, you could replace it with a different company in the same sector, or with a technology sector ETF. The goal is to avoid missing out on a market rebound while still booking the tax benefit. These are not the same thing. Being out of the market entirely for 31 days is a risk. Being in a similar but different investment carries almost the same exposure with none of the wash sale concern. Now let's talk about what to actually look at in your portfolio. The most productive place to start is with positions you have held for less than a year that are currently sitting at a loss. These are short-term losses, and they are the most valuable kind because they first offset short-term gains, which are taxed at your ordinary income rate, rather than the lower long-term capital gains rate. If you have short-term gains from active trading, or from selling positions you held less than 12 months, those gains can be very expensive at tax time. Short-term losses cancel them out dollar for dollar. Long-term losses, from positions held more than a year, offset long-term gains first. Any leftover losses from either category then cross over to offset the other type before finally being applied against ordinary income up to that $3,000 annual limit. Go through your taxable brokerage accounts and make a list of every position currently showing a loss, not your retirement accounts. Tax loss harvesting only applies to taxable accounts because IRA and 401k accounts are already tax-advantaged, and gains inside them are treated differently. Once you have your list, identify which losses are large enough to be worth acting on after you factor in transaction costs and the hassle of managing the replacement position. There is also a timing dimension that most guides skip over. You do not have to wait until the end of the year to harvest losses, and in fact, waiting can work against you. If a position recovers before you sell it, the loss disappears and the opportunity is gone. Tax loss harvesting done throughout the year as losses develop tends to be more effective than a frantic December sweep. But if you have not done it yet this year, the window before your tax filing deadline is still open, and it is worth acting on before it closes. Here is the counterintuitive part that changes how most people think about investment losses. A losing position is not purely a bad thing. It is a tax asset. The same way a business can write off expenses to reduce its taxable income, a losing investment in your portfolio has a hidden value that exists entirely separate from its market performance. You are not just deciding whether to hold or sell based on whether you think the stock will recover. You are weighing the tax value of the loss against the potential upside of staying in. Sometimes selling the loser and capturing that tax benefit is actually the more financially rational move, even if the position later recovers. The investors who build real wealth over time are not necessarily the ones who pick the best stocks. They are the ones who keep the most of what they earn. Every dollar you do not pay in unnecessary taxes is a dollar that stays invested, compounds, and grows. Over decades, that difference is enormous. Tax loss harvesting is one of the few strategies that lets you convert a losing position into a concrete financial benefit, and you do not need anyone's permission to use it. You just need to act before the deadline does it for you.